Alibaba is more than 55% down over the last 5 years. It is trading right there towards its 52-week lows, and we see a massive strong buy rating from Wall Street, and they are not the only ones. In fact, when we look at these super investors, in quarter one of 2024, it was the 6th most bought stock, with 5 super investors buying heavily into this Chinese company. And in today's episode, we are going to do a deep dive of Baba. We're going to take a look at this company, where the numbers have been historically on their free cash flows, their sales, their ROICs, where they expect to go into the future. We'll also look at the institutions, whether they are also copying what these super investors are doing with their buys year on year. And we also want to take a look, put it back into our valuation model, getting to our intrinsic value. What is our acceptable buy price now with the updated numbers, with our investor margin of safety as well? And do Wall Street consider this to have enough upside to take on any of the risks that you do see with this company over the next 5 to 10 years? So as a quick highlight of their historical performance, but before that, we do get that strong buy from Wall Street, a buy from Seeking Alpha, and a hold from Quant. Now, this is a company that does pay a yield. Now, on a trailing 12-month basis, it sits at 2.7%. In terms of a forward P, 9.11. Now, just to put it into perspective, the S&P right now sits at around 22.5, but again, for relevancy, we will compare it to the sector PE. It trades towards their 52-week lows. Over the last 5 years, down 55%. Over the last 12 months, down 12%. And year to date, we can see down 3%. Now, when we take a look at their numbers, as always, what we want to see is growth over the longer term, as well as on a year-on-year basis, 3 to 7% as a minimum. And look at this fantastic growth. 12 billion in 2015, 130 billion in their more recent annual accounts from March 2024. And when we look at it on a graphical basis, we do see some very nice growth over the longer term. But what we can point out is just over the last 3 years, we have seen that growth start to stabilize and slow down. Now, we will focus on the percentage increase later on in the episode as well, as we want at a bare minimum that 4% inflationary increase to the top line. In terms of the bottom line net income, same to be said, we want to see growth just under 4 billion in 2015, and we see nearly tripled in their latest annual accounts, just over 11 billion. And when we do look at their bottom line, it does give us a little bit of a different trend than their top line, a lot of inconsistency. Even though we see that growth over the longer term, it doesn't necessarily follow their top line revenue, something just to consider when you're looking at your own investment analysis. Then when we take a look at the health of this company, very important, total cash versus total debt. What we note, they have a lot of cash. In fact, 10 years ago, they had 20.3 billion. Now in their latest quarterly report, just under 80 billion. So 4 times growth on the cash. They are sitting on quite a significant amount. And when we do look at it, similar to their revenue, it has been increasing over the longer term. Now, yes, this is a very large number, but as always, it doesn't really mean anything in isolation. We do have a very quick comparison to their total debt, both numerically and directionally. 8.5 billion then in 2015, 28.5 billion in their latest quarterly report. So yes, similar to their cash, their total debt has increased. But what we note, their total cash is significantly superior than their total debt. Therefore, it wouldn't even take Alibaba 1 day to pay off all of their debt net of cash on hand. Then we move on to their earnings. Now, why the historical performance is important, because we want to have faith when we do look towards their next quarter, their next year targets as well. What we see over the last 4 quarters, they have missed 2 out of the last 4, which is a 50% track record. And also, we want to point out the last 2 have been misses. Now, moving forwards, where is the expectation? Well, quarter 1 of FY25, they are expecting double-digit negative year-on-year EPS growth. The same for the following quarter. It isn't until the 4th quarter out where they are expecting growth on that earnings per share. And if you do have confidence in these targets, their earnings per share for 2026, 9.2, would indicate a forward P of 8.13. Again, whether or not you do get that faith based on their historical performance. Then we move on to some gradings and underlying metrics. First one that we want to point out is their valuation. Now, a B-, let's take a look. First one we want to point out, 9.11 on a P non-GAAP basis forward looking. They are trading far lower than the sector median of 16. So in fact, for Alibaba, you are getting a 42% discount. Now, do bear in mind before you jump to any conclusions, it could be warranted. They could be having metrics like growth, profitability a lot lower. So before we do hit that buy button, a few other things to consider. But the general theme across different types of valuations is overall, they are trading at a significant discount to essentially the sector as a whole. We then move on to the growth grade. Now, they get an F, so a few things to point out here. Firstly, year on year, 8.34%. Sector median, a lot lower at single digit, a low 2.15%. Forward looking as well, Baba are anticipating 7%. Sector median, again, low single digit. And one of the things that we do like to look at is that earnings per share growth over the next 3 to 5 years. Just under 10%, sector as a whole just over 11%, hence why we do get that C-. There are a few other things that you can take from here if you want to focus that as well. We do get to see their operating cash flow both on a year-on-year and forward-looking basis is negative, and we can see in comparison to the sector, it is a lot better. One of the reasons why we do see that growth grade looking at an F, even though we do see it outperforming on both the revenue and other metrics like the EBIT growth as well. Then we move on to essentially their profitability. Now they get an A+, which is interesting. Their gross margin is pretty much in line with the sector at around 37-38. Their bottom line, 8.5%. It is better, although marginally, than the sector median of 5%. And one of the reasons why we do see that massive A+, as we can clearly see here, their cash from operations, 25 billion. In fact, the sector median, 285 million. Other metrics as well, whether or not you want to incorporate, they are here, so you can take a look. Quick conclusion for this part of the analysis. Buy rating from Seeking Alpha, a strong buy from Wall Street, hold from Quant, B- on valuation, an F on the growth, with an A+ on the profitability. Now, what's always interesting to see whether or not there are any trends we can identify when looking at other competitors or the industry as a whole. Broadline retail, we have PDD Holdings, Process NV, Mercado Libre, JD, Coupang, all of these big well-known companies. And what we can see now, total return, so includes dividends reinvested. Alibaba over the last 12 months, the worst or one of the worst performing, in fact, negative 9%, as we can see here. JD down marginally worse at negative 16.58. In terms of over the last 5 years, no real surprises. Then negative 54%, they are the worst performing. Now you could argue the industry as a whole hasn't performed that well over the last 5. You do get Prozzy down negative 2%. JD up marginally 5%, Coupang down 57%, with really the big leaders being Melli as well as PDD. When we expanded over the last 10 years, what we get to see again, no surprises, Alibaba one of the worst performing, negative 18%, although you do see some real winners here in PDD and Melli. So overall, Alibaba's historical performance has been terrible. In all honesty, you don't want to lose money when you invest over the longer term, but key thing to understand is whether or not right now it is significantly undervalued, and actually over the next 10 years, not only it'll be one of the best out of its competitors, but will also outperform the S&P. Now, in terms of the S&P, over the last year, up 26%, Baba down nearly 10%. Over the last 5 years, S&P up 85%, Baba down 54%, and when we do look over the longer term, the S&P has significantly outperformed. Now, what is interesting to note, there have been some times over the last 10 years where Alibaba has outperformed the S&P, but the main question you need to ask yourself, especially for the newer viewers, when looking at individual stocks, do you believe this company will outperform the S&P over the longer term? If you have some confidence with that and you have faith in your investment research, analysis, due diligence, then it may be one to consider. But if not, go ahead, look at low-cost ETFs like VO, and I'm sure there are many others that people can explain. Now, before we jump into essentially talking about the underlying metrics like the dividend safety, their growth, a few things we want to point out. Now, we don't get any of the information in terms of recent insider trading like we typically do on this channel, but what we can see is there has been some recent insider trading or trading by US Congress members. And if you want to do take a note here, it isn't anything of value that we will say we'll use in our own analysis, but we can see it does look like there are a few people. Tommy Tuberville loves to be trading this, buying and selling quite frequently. But again, for transparency, not something we personally would include in our own analysis. Now, in terms of institutional ownership, well, around 13.5%. We see around 4 billion worth of sales by the institutions over the last year. We see just over 5.5 billion over the same time period. So effectively, institutions have been buying more than they have been selling. And what we also note in Q1 2024, they have been buying more as well, 433 versus 373, and the same to be said for the previous quarter. So not just over the last month, but also over the last quarter, the last few quarters in fact, and over the last year, institutions are buying Alibaba. And as we saw earlier on in the episode, super investors also do quite like this, as we saw the 6th most bought stock in Q1 of 2024. Now, before we do anything else, just to let you know, we have released our latest free weekly article where we run through 10 undervalued stocks that have some excellent balance sheets as well. If you want access to this completely free, do click on that pinned comment below. You also get access to all of these other articles that we do put here out that are, again, ready for you to read straight away. So let's jump into essentially the free cash flow and other metrics. Dividend safety, we do typically get a score, but given for Alibaba, they've recently started to pay a dividend. It isn't one that we do have right now. Market cap, 181 billion, a mega cap company. And we do know over the last full year, they have increased that dividend just above that 4% inflationary target that we do like to see on the channel. Now, in terms of looking at other metrics, now firstly, free cash flow payout, we do draw your attention to this. Earnings, as always, susceptible to manipulation by management through accounting. What this shows, this free cash flow is very, very low as a payout metric. We would like to see double-digit increase given how low it is, so a little bit disappointing to see that 5%. Something to keep an eye on, but over the longer term, we would expect them to be increasing at a very rapid rate. In terms of the free cash flow, what we want to see here, increasing over the longer term and consistent. We do get it for the large part, although we do note the big drop into 2022. Nice to note it has rebounded into 2023, and even though it dropped again in 2024, the expectation over the next 12 months is to see some very strong growth. We then look at the sales growth, something that we did refer to earlier in the episode. Double-digit increases is what we love to see, 3 to 7 as a minimum. Now, we do know 2023 it was marginally lower than that. Nice to note over the more recent year, it was sitting strongly at 8%. And hopefully, over the long term, they can continue to increase at a very nice rate, like we have historically seen. But also something to consider whether or not you do believe they will continue with those nice increases, and factor in, as always, into that margin of safety. Total sales, well, nice, we did see this earlier, so another format to view. Shares outstanding, now we love companies that do share buybacks, returning excess cash, effectively increasing your portion of controls of a company. And with these prices incredibly low for Alibaba, we would like them to do a lot more over the longer time. Now, in terms of the net position, as we can see, marginal share dilution as they did increase it from 2015 up to 2021. Since then, over the last few years, they have been doing some share buybacks. Hopefully, this trend will continue. Now, ROIC, 10% or more, give us faith management are able to effectively allocate their capital, pretty much straddling around that year on year, 10% in the more recent year. We then move on to the margins. Now, this isn't a good sign personally. What I like to see is increasing operational efficiency, increasing margins, increasing revenue. We have noticed it has come down. Now, the more recent year, 15%. At a minimum, we want to see 16%. So this isn't too bad. We just want to see it go back up to the nice levels we saw from 2015 to 2018, although you could argue that competition is ensuring that this margin continues to get suppressed. We then move on to the free cash flow margins, 7% or more, which is what we get, but again, it has been decreasing. Something just to consider whether you see this trend continuing into 2025 and beyond. Net debt to EBITDA, what we love about this metric, correlates to both dividend safety and balance sheet strength, the earnings before interest, tax, depreciation, amortization. Now, these are the number of years it would take the company to pay off all of their debt net of cash on hand. Won't even take them one day over the last 10 years and anticipated over the next 12. So an incredibly strong balance sheet, as we did mention earlier. Now, let's jump into the valuation model. As always, if you are enjoying the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, jumping into the first model, we have Graham's valuation, the stock ticker symbol, earnings per share, growth rate, their AAA corporate bond yield, and we get to an undervaluation signal, the first one today. Now, that is a very nice undervaluation signal, but as always, do bear in mind, we don't look at any of these models in isolation. We then move on to the multiples valuation model, a couple of companies in a similar sector and size, average P multiplied by that of the EPS of Baba, and we actually get an overvaluation signal. So what this is effectively telling us is that Alibaba, in comparison to others in the sector, is trading at a higher forward PE. We then move on to the dividend discount model. However, given they have just started recently paying dividends, this isn't one we will use for the foreseeable future. We then move on to the DCF model, free cash flow year on year, average growth rate just under 30%. Now, we want to be extremely conservative. We've gone probably overboard at 0% growth. We do believe it will grow much larger. With that discount rate, we get the present value of future free cash flows and terminal value. add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and as we can see here, a large undervaluation signal, and that is purely based on zero growth moving forwards. We then get to the intrinsic value. Now in today's episode, it is the average of these three models, and it does arrive at $129. Don't forget you can grab a copy of this model by clicking on the pinned comment below, running your own numbers through, whether it's for Alibaba, companies in your portfolio, or those on your watch list. So a 10% margin of safety, always start off with that, and we believe to use that if it meets our three golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that it is a buy up to 116, then we keep going to see what is the margin of safety that we are looking at today. And we can see in today's episode, it is around a 40%. At 45, it would be around $71. So you have to ask yourself, with the risk for Alibaba, which we have discussed quite in length in previous episodes, whether or not 40% margin of safety is one that will entice you to start a position. In terms of Wall Street and their forecast, well, over the next 12 months, they do quite like this company. As we saw, not just Wall Street who have been buying, as well as super investors, they consider this price target $109, and they have upside of 47%. As always though, do let us know your thoughts in the comments below. A lot of people will not touch this stock, whereas a lot of people see a massive amount of value over the longer term. Just bear in mind, over the last 5 years, it is down 55%. However, having said that, their past performance has nothing to do with how their future performance will be. This is a strong company, a lot of cash on that balance sheet. It is looking very strong. Margins do look a little bit questionable. They have been decreasing. Sales growth, the same as well. We do see over the last 2 years, it's slowed down in comparison to the previous 10. But again, you have to ask yourself, is the margin of safety that we see at 40% sufficient? As well as Wall Street, who do consider this a strong buy, as well as super investors who have put their money where their mouth is. As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.